Did the strategy to cut ties with China unexpectedly backfire in a way almost no one foresaw? Because right now, the plan that was supposed to strengthen America is beginning to show weaknesses, and those who promoted it are struggling to explain what's happening behind the scenes. Today, we're examining a narrative that appeared strong on the surface, but is now crumbling under its own weight. And the deeper you look, the more hidden details you uncover. In this video, you will learn how some bold claims are proving false, why the United States is quietly downplaying significant job market issues, and how increasing pressure is sending shockwaves through American tech stocks. You'll see how all these events connect, forming a much larger story that most people never notice because it doesn't make the headlines. There's an aspect of this crisis that experts rarely discuss, and by the time we finish, you will understand the risks that are currently building across the American economy. This isn't just about politics. It's not just about China. It's about a chain reaction that starts with a single claim, spreads into trade policy, impacts American workers, and finally affects the stock market. We are going to break it all down step by step with simple words and clear explanations so you can follow exactly what went wrong, who is being affected, and what could happen next. If the pressure continues to mount, you will hear why the job numbers that are meant to show strength are far more fragile than they appear. You will see how separating from China has created problems that no one anticipated. You will understand why certain technology companies are suddenly struggling even though the economy is supposed to be stable. And you will learn about the quiet warnings coming from within financial circles that hint at deeper instability. The reason to stay until the end is simple. The final part of this video will show you the complete picture. It will bring together the hidden job losses, the failing political narrative, the decline in tech stocks, and the risks that experts aren't openly discussing yet. By the end, you will be able to see the pattern that links all of these events, and you will understand why many insiders believe the next few months could be far more unpredictable than anyone expects. If you want to know what's truly happening behind the scenes, this video will take you there. So, get ready because we are about to uncover a story that powerful people wish would remain quiet. Welcome to our channel. And if you want more in-depth, clear, and honest explanations like this one, make sure to subscribe. The term cancel China refers to a growing effort within the United States to reduce its economic ties with China. This includes new tariffs, restrictions on technology exports, limits on investment, and a broader push to move supply chains out of China. Supporters of this approach argue that the United States must protect itself from China's increasing power in manufacturing, electronics, and advanced technology. The message is simple on the surface: reduce reliance on China and rebuild American strength. But beneath that message are ideas, claims, and warnings that help drive this movement. One of the loudest voices behind this push is Scott Bessent. He has repeatedly warned that China's growth has harmed the American workforce. One of his most talked about claims is that the United States lost 3.7 million jobs due to trade with China, a figure that has been widely used in discussions about tariffs, bringing jobs back home, and industrial policy. His message suggests that China's manufacturing boom came directly at the expense of American workers, turning trade into a threat rather than an opportunity. These claims gained attention because they resonated with public frustration over factory closures and shrinking industries. Even though economists continue to debate the true extent of those losses, statements like Bessent's have influenced how many policymakers view China today. Because of these warnings, the story around China changed quickly. It became a common topic in speeches, campaigns, and economic plans. It helped justify new tariffs on Chinese goods, new barriers to Chinese technology companies, and a greater push to build more American factories. It also influenced rules targeting Chinese involvement in sectors like microchips, rare earth minerals, energy storage, and electric vehicles. The cancel China idea became more than just a phrase. It became the emotional force behind major changes in trade policy and technology strategy. This movement grew even stronger as it entered public discussion. Concerns about national security blended with concerns about jobs. Technology separation became part of the story. with the United States attempting to limit China's access to advanced microchips and artificial intelligence. Companies began moving supply chains to other countries, not just for cost reasons, but to avoid political risk. At the same time, China responded with its own countermeasures, which added more pressure to global markets. The story became bigger than one person's claims. It became a framework that shaped how politicians, investors, and companies act. By understanding what Cancel China truly means and how strong voices like Scott Bessent helped promote it, you can see why it has become such a powerful force in shaping current economic decisions and why it continues to influence policies that reach deep into technology, trade, and the American job market. Scott Bessent's warning about 3.7 million American jobs lost to China sounds dramatic, and that's why it spread so quickly. But when researchers looked closely at the numbers, the picture turned out to be very different. Several economic studies, including work highlighted by the Civitas Institute, showed that the real job losses linked directly to China are likely far smaller. Some estimates suggest the true figure may be overstated by 2 to 4 times. That means the actual number could be closer to 1 million or even less when separating normal economic shifts from the specific impact of imports from China. This doesn't erase the hardship felt in many factory towns, but it shows that the story is more complicated than a single headline suggests. Manufacturing job losses in the United States have been happening for decades, long before China became a major trading partner. Automation played a huge role as machines began to replace repetitive factory work. American companies also moved operations to other countries such as Mexico, Vietnam, and Malaysia, not just China. Consumer preferences changed, supply chains expanded overseas, and industries reorganized. When you put these factors together, you see a long-term decline shaped by technology, management decisions, and global competition, not only by Chinese imports. The Civitas Institute emphasizes this trend, showing that a broad mix of forces contributed to the shrinking manufacturing workforce. At the same time, there is a growing idea of a hidden jobs crash inside the United States. This doesn't mean a sudden collapse, but rather a slow and quiet erosion happening underneath the official numbers. Companies are laying off workers in small groups instead of making big announcements. Some are cutting full-time positions and replacing them with contractors. Others are moving employees into different roles that are counted differently in government data. Workers who lose stable jobs often shift into lower-paying service work or short-term gigs, which keeps unemployment numbers low but hides the real economic impact. This creates the appearance of a strong job market even when the quality of work is falling. The word hidden doesn't imply a conspiracy. It points to gaps in the way employment is tracked. A job may still count as a job even if the pay is lower, the hours are unstable, or the person moved from skilled work into basic service roles. Many Americans are taking on gig work to fill financial gaps. These gig jobs don't always show up clearly in labor statistics. There are also mislabeled roles, temporary jobs treated as permanent, and part-time workers counted alongside full-time employees. All of these details blend together, making the job market appear healthier than the reality many families experience. Understanding these layers helps reveal how the narrative around the 3.7 million jobs grew strong, even though the underlying data tells a different story. The Cancel China narrative, which once sounded clear and powerful, is now facing growing opposition. As more economists re-examine the evidence, they are finding that China's impact on American jobs and industries may have been far smaller than the loudest claims suggested. Research highlighted by groups such as the American Enterprise Institute shows that the numbers behind the China shock were often stretched to support political arguments. Many of the losses blamed on Chinese imports can be traced to automation, business mergers, and long-term structural changes in manufacturing. This new wave of data is creating resistance, raising doubts about whether the aggressive separation strategy has been built on a shaky foundation. These doubts are spreading into the financial world, where investors watch every sign of tension between the United States and China. Markets react not only to economic facts, but also to political signals. Recently, increasing export controls on advanced microchips, restrictions on high-tech equipment, and China's own moves to tighten control over rare earth materials have increased uncertainty. Reports have shown that these tensions are keeping investors uneasy, with market reactions reflecting fear of supply chain disruptions and profit risks. When two of the world's largest economies clash over technology and resources, traders expect more volatility, and that fear can spread quickly through global markets. As these pressures build, the meaning of a collapse becomes clearer from an economic perspective. It doesn't mean that policies disappear overnight. It means that the arguments used to support rapid separation are losing credibility. When the evidence shows weaker job impacts than advertised, the political case becomes harder to defend. When companies face higher costs from relocating production, the promised benefits look smaller. When tech restrictions cause retaliation, the economic upside becomes uncertain. Many businesses that once supported a strong break from China are now calculating the financial risks of moving too fast. Behind the scenes, more companies are quietly expressing discomfort with aggressive separation because the expected gains are not matching the realities they face. Supply chains that took decades to build cannot be replaced in a few years without major cost increases. And these costs eventually fall on American consumers. Some firms are quietly slowing their plans to leave China, exploring mixed strategies instead of a complete withdrawal. Investors see the shift, and it adds another layer of pressure to a narrative that once seemed unstoppable. Pressure created by the Cancel China narrative doesn't stay inside policy debates. It moves directly into the stock market. And the first sector to feel the impact is technology. When tensions rise between the United States and China, investors immediately worry about supply chains, component shortages, and higher production costs. Tech companies rely heavily on Chinese manufacturing, rare earth minerals, and access to the Chinese consumer market. So when political messages shift toward separation, the market reacts before any policy becomes real. Even small signals of strain can pull tech stocks down because traders understand how closely these companies are tied to global stability. This sensitivity became clear when Scott Bessent made sharp comments about China's economic problems and its control of key resources. Markets dropped right after his warning, showing how influential such statements can be. Investors see comments like these as hints that tougher restrictions or new conflicts may be approaching. For tech companies, even a hint of disruption in chip production, battery materials, cloud services, or electronics assembly can trigger immediate selling. When sentiment turns negative, tech stocks fall faster than other sectors because their valuations rely heavily on growth expectations and stable global supply lines. The risks go further than simple market reactions. Many American tech giants depend on China not only for parts, but also for revenue. Losing access to the Chinese consumer base can wipe out billions in future sales. At the same time, new export controls from the United States aim to block China from advanced microchips and high-end equipment, which adds more tension between the two countries. China has responded with its own limits on rare earth materials and other strategic resources. Every new restriction adds another layer of uncertainty that investors must consider. As these pressures accumulate, panic can move through the market quickly. A single announcement about export rules, a new tariff, or a warning about declining demand can send tech shares sliding. Companies dealing with already tight profit margins feel the strain as costs rise, production slows, and foreign revenue becomes less predictable. Smaller tech firms with limited cash reserves face even greater risk as any supply disruption can hit them harder than the industry giants. This environment creates a cycle where fear leads to selling, selling leads to lower valuations, and lower valuations increase concerns about the sector's ability to handle further shocks. The impact of these rising tensions doesn't stay in boardrooms or financial charts. It reaches directly into the daily lives of ordinary people. When supply chains become unstable, the cost of everyday goods increases. Electronics, cars, household items, and even basic tools depend on parts sourced from China. If those parts become harder to get or more expensive to import, the final price paid by consumers rises. Families feel this in higher prices for phones, laptops, appliances, and even groceries because many food processing machines and packaging materials come from factories linked to global supply networks. Jobs also become vulnerable when companies face uncertainty. They slow hiring or quietly reduce staff. Workers may not notice this immediately because the cuts often happen in small steps rather than large layoffs. Some jobs shift into lower-paying roles, others move into part-time arrangements, and many disappear into temporary contracts. As trade and tech tensions continue, industries that depend on electronics, engineering, logistics, or manufacturing feel the stress first. Workers in these sectors see fewer opportunities, smaller wage increases, and more pressure to take on less stable roles. Tech access becomes another issue. If separation intensifies, consumers may face delays in new product releases, fewer model choices, and reduced innovation. Many of the most advanced components come from global cooperation between American design firms and Asian manufacturers. Breaking that system slows progress, raises development costs, and limits how quickly new technology reaches the market. This affects everything from smartphones and computers to electric vehicles and medical devices. The effects don't stop at the American border. The global economy is tightly connected, and the US-China tech and trade conflicts send shockwaves across Europe, Asia, and developing countries. Nations that rely on exporting materials to China or importing finished goods from the United States feel the strain. Inflation rises when supply chains tighten. Factories in different countries slow production because critical components are stuck in political restrictions. Jobs overseas face the same uncertainty that workers in the United States experience. For investors, this environment requires constant awareness. Market swings can happen without warning when new restrictions are announced or when companies reveal cost increases linked to supply disruptions. Understanding the context is essential because even strong companies can face sudden drops when political tensions shift. Staying informed helps protect savings, long-term investments, and retirement plans from unexpected shocks created by these global pressures. Several indicators can help show where this situation is heading and how much pressure is building beneath the surface. One of the first signs to watch is the job market data in the United States. When unemployment stays low but full-time positions decline, it often signals weakness hidden beneath the surface. Manufacturing employment numbers are even more important. If factories keep cutting staff or freezing hiring, it suggests that companies expect slower demand or higher costs ahead. These shifts can reveal stress long before it shows up in official reports. Export controls are another key signal because every new restriction on microchips, software, or advanced tools immediately raises the risk of supply chain problems. When companies begin reporting delays or shortages, it usually means tensions are tightening again. Diplomacy between the United States and China is also a guide to what may come next. New tariffs can appear with little warning, and each round affects a different set of products or industries. Rare earth materials are especially important because they are essential for electronics, batteries, and military technology. Any signal that China might tighten control over these materials creates instant concern in global markets. On the other side, American restrictions on Chinese tech companies or chip access can trigger retaliation, which adds more uncertainty. Watching these diplomatic moves helps reveal whether the situation is easing or moving toward a new round of escalation. Tech stock performance is another major indicator. When companies release earnings reports, their guidance often includes warnings about supply costs, market access, or regulatory pressure. If firms with heavy exposure to China start reducing forecasts or adjusting production plans, it usually means conditions are worsening. Investors also pay attention to how dependent each company is on Chinese manufacturing or Chinese consumers. The higher that dependence, the more sensitive the stock becomes to political signals. Sudden drops in share prices often show that traders expect trouble before the public hears about it. Policy shifts inside the United States are equally important. Leaders may begin reconsidering the speed of the Cancel China strategy if the economic side effects become too large to ignore. Slower growth, rising prices, or declining corporate profits can push officials to soften their stance or explore more flexible arrangements. At the same time, China may choose to respond more aggressively if it feels targeted, which could include stricter controls on exports, new regulations on foreign companies, or shifts in diplomatic tone. These responses create a cycle of action and reaction that shapes the outlook for trade, technology, and global markets. The Cancel China narrative began with dramatic warnings about massive job losses and the promise that cutting ties would fix everything. But as we have seen, the data tells a different story. The job numbers were far smaller than advertised, and the real damage is showing up in quieter places: hidden layoffs, downgraded work, and a job market that looks stronger on the surface than it feels for many families. At the same time, tech stocks are feeling the pressure as supply chains tighten and investors react to every new sign of tension. The fallout is real, and it is spreading farther than the original story ever admitted. What this shows is simple. In a global economy, where every country, every factory, and every supply chain is linked together, bold moves carry big risks. Separating sounds powerful in speeches, but in the real world, it sends shocks through markets, industries, and households. The effects don't stop with one policy or one headline. They continue to unfold across jobs, technology, inflation, and investment. And this story is not finished. The next few months will reveal whether the United States doubles down, slows down, or shifts direction entirely, and how China chooses to respond. Now, we want to hear from you. What do you think will happen next? Will the tensions rise even higher, or will both sides pull back? Share your thoughts in the comments. And if you found this breakdown helpful, make sure to like this video and subscribe to our channel for more clear and honest analysis on the biggest economic stories shaping our